Everybody, it is Friday the 23rd of September, and we finished up a pretty ugly week here for the market. The pretty much across the board down 5%. Energy names, as we know, have been the leader this year. They dropped 10%. So really nothing was safe this week. Bonds, everything was down. So let's go back to those charts and make some sense of it. Now that we're down 22.5% year to date in the S&P 500, we've come close to, but haven't undercut the June low yet. I think that it would be preferable that we undercut that next week before any real bounce starts to commence. We're pretty deeply oversold, and as I pointed out on the weekly chart, we're right at the 200-week exponential moving average. And I don't talk about these longer-term moving averages a lot because I'm a intermediate-term trader, shorter-term really, what most people would say. But once in a while they become useful. You can see that, in this case, we touched it in 2016, 2019, earlier this year, and then again. So only a handful of times. But when it has tested it, it's been important. The prior touch earlier this year, that's where we started that big bounce, and that's where it came right up to the declining 200-day moving average. So it's not just about the volume weighted average price levels. You can see I use other tools as well, but not as significantly. So, it looks like we held there for now, and we got that only happened because we got a little bit of a bounce here late in the day. Here's our daily. This is today's action. We gapped lower, sold off most of the day except for that last 40 minutes of the day where we saw a bounce. And there's zero evidence here that buyers are in control or gaining control. Just because we see a level tested and seems to be holding, we have to look at the action on a shorter term time frame and say, are the buyers actually gaining control here? And with it below the declining 5-day moving average, I'm still calling it guilty till proven innocent. As we know, this week we saw the volume weighted average price from the CPI tested perfectly on Wednesday after the Federal Reserve, and then the market experienced a very strong decline from 388 down to 363, straight down from there. So we're guilty till proven innocent below a declining 5-day moving average. I'm not going to change my mind on that. And I'm going to still, though, look at these important levels and say, it makes sense to be aware of this level and to maybe not be aggressive with short sales, but it doesn't make sense to just jump in and buy based on that. If you had purchased, this morning as it touched that that 200-week exponential moving average, you would have basically purchased right here at this price. Let's just call it 368, and you would have experienced a 5-point decline. So it certainly wasn't just, people will point to it. Maybe let's say this does become a low. People will point to it and say, yeah, the 200-week exponential moving average, I knew that was the low, but you had to take 5 points of heat. It's not a level to take action. It's a level of interest where we look for shorter term time frames to look for the evidence buyers are in control, and we simply do not have that evidence yet. So I'm not ready to call a bottom. As I always say, they're more likely to scare you out. Wear you out if they don't scare you out. That we're not due for a V bottom in this market. It could be something that takes some time. Below here, we have the volume weighted average price from the 2018 low. That would occur at about 353 or so. Let's just take a look, 354-ish, and the 200-week simple moving average. Enough of the S&P for right now. Let's talk about the semiconductors, because this group did undercut the June low, only by a little bit, but still it undercut it and came close to the 200-week simple moving average. If we look at this longer term 2016 volume weighted average price and then the 2019 volume weighted average price, you can see that the volume weighted average price from 2019, we've got this little cluster with the 200-week moving average in that VWAP. It's possible we could see further flush down there, and then perhaps a rally would occur. And we'll probably see the same thing that people have spoken about every rally. Hey, that's it, that was the bottom. We haven't seen any real bottom. The sum of the declines is still greater than the sum of the rallies. Here's that low from previous. I'd still like to see some further shakeout, and then perhaps up here. And I'm not going to call that a bottom if we start to rally. I'm going to say it's an emerging trend. I would rather look to get short over over here in a week or two if we were to get that bounce than to look for the bottom because the evidence simply isn't there. We're below declining 5-day moving average. It's guilty till proven innocent. So that, of course, puts the NASDAQ in the same situation. The NASDAQ, we'd like to see it undercut this low and then perhaps look for evidence that a bounce may be emerging. The Russell 2000, same story. We'd like to see that undercut. The Dow Jones, I don't talk about a lot, but this market did undercut that low. So that's just something to keep an eye on. It's possible that the Dow could be the leader back to the upside for a bounce. And again, with a declining 20-day, that's that blue, the 50-day declining, the 200-day moving average declining. It's below the year-to-date volume-weighted average price is pink. This green volume-weighted average price from the prior low. I mean, it's below everything of significance here. When we look at that weekly time frame, we're right on the 200-week simple moving average. It's just broken. There's no reason to be looking to be a buyer in these markets. The biotechs, as we know, they had been the group that was leading. I was highly suspect, and we've broken down. This is now looking more and more like a head and shoulders pattern. I'm not a big pattern trader, but when I see them, of course, I'm going to point them out. This is 135, let's call it, down to the neckline. We'll call it 122, so that would make our target, the height of this pattern 13 points. We take 13 points from the breakdown point at 122, and that would give us a price target of 109. I'm not into price targets. I think it's a likely area, a level of interest. What I'm more interested in is managing risk on the shorter term time frame. On Wednesday, we came up to the declining 5-day moving average after the Federal Reserve and then just got annihilated. So it's guilty till proven innocent. You might be able to find bounces along the way, but all these markets are guilty till proven innocent. Energy names, we've been talking about how we simply do not want to buy them below that declining 5-day moving average. And a lot of people are have been thinking, hey, the energy names were the leaders. I've got to get back involved in them. But they're showing on the daily time frame a pattern here of this high and a lower high, this low and a lower low. That's called a downtrend, lower highs and lower lows. If you look at the weekly time frame, perhaps we're going to head down towards this 68 level. And on the intermediate term, there's just no reason to be a buyer there. Again, I talk about this stuff all day on Twitter. If you're not following me there, you're missing out a lot. Please give this a thumbs up and share it, and have a good weekend.